Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here, and welcome back to episode 82 of the 5-Minute Prime Podcast. Last week, we completely reframed the conversation around refinancing. We established the investor's mindset. It's not about the lower payment. It's about generating a bigger paycheck by achieving capital velocity. We broke down your two primary tools, the stable, lump sum cash out refi, and the flexible, powerful HELOC. Today, we build the rest of the machine. This is the advanced playbook, the how-to. But we're going beyond the basics of loan approval. We'll start with the strategic audit you must conduct before you ever talk to a lender, dissect the common but costly analytical traps that can sink your deal, and analyze how to navigate the bizarre market we're in right now. And to cap it all off, I'll give you a masterclass on the BRRRR method's crucial adaptation for today's market, the Slow BRRRR. Let's dive in. Before you even think about gathering documents or calling a lender, you need to conduct a strategic audit of your own. Getting approved for a loan is a tactical step. Deciding if you should refinance is a strategic one. You need to answer 3 critical questions with total honesty. Question number 1, is this asset truly stabilized and ready? Refinancing is not a tool to fix a problem property. A lender isn't going to give you cash out on a building with high vacancy, deferred maintenance, or tenant issues. Stabilized means your rent roll is solid, collections are consistently above 95%, and your net operating income is stable and predictable. You refinance from a position of strength, not weakness. Question number 2, what is the true cost of this new capital? This goes beyond the interest rate. You have to calculate the total cost to access your equity. Closing costs for a refinance typically run 2% to 5% of the loan amount. So on a $300,000 loan, that's $6,000 to $15,000 in fees, appraisals, origination, title, that you're paying just for the privilege of getting your money. Is the opportunity you have for that cash worth that upfront cost? Question number 3, what is the specific mission for this capital? This is the most important question. Don't pull out equity just to have it sit in a bank account. You must have a clear, defined mission for that money before you start the process. It's not a vague idea like, I'll find a good deal with it. It's the down payment on the 12 unit on Elm Street that you've already run the numbers on. It's for the specific renovation project where you have a contractor bid in hand. That cash has a cost, and it needs to be deployed into a new income-producing mission immediately. Only after you can answer these 3 questions with confidence should you move forward. Okay, you've passed your own strategic audit. Now you have to make sure the deal actually makes financial sense. This is where I see investors fall into the same analytical traps over and over, turning a good idea into a bad outcome. The first trap is the break-even blind spot. This is the most important calculation you will do. The formula is simple. Take your total closing costs and divide them by your monthly savings from the new lower payment. If your closing costs are $9,000 on a $300,000 loan and you're saving $250 a month, your break-even point is 36 months. 3 full years. If you plan to sell the property before you hit that break-even point, the refinance is a losing move. Period. The second trap is the amortization illusion. When you refinance a 30-year loan that you've been paying on for 5 years, you start over with a brand new 30-year loan. It feels great to get that lower monthly payment, but you've just added 5 years of payments onto your financial life. You could end up paying significantly more in total interest over the long run. Third is the leverage mirage. Pulling out every last dollar of equity can feel powerful, but it leaves you with zero cushion. A 75% LTV is the max for a reason. It ensures you have a 25% equity buffer. If you get over-leveraged and property values dip even slightly, you could end up underwater, owing more than the property is worth. That makes it impossible to sell or refinance again, trapping you in the property. And the final trap is the lender loyalty fallacy. Just taking the first offer you get from your current bank is like willingly leaving thousands of dollars on the table. You should get formal loan estimates from at least 3 different lenders, a big bank, a local credit union, and an independent mortgage broker, to compare not just the interest rate, but all the fees line by line. Now, let's talk about adapting to the market. As we discussed in episode 35 when we reviewed David Green's book, The classic BRRRR method is a sprint. In the low-rate era, the goal was to refinance and get your capital back as fast as humanly possible, often right after the 6-month seasoning period. But in today's high-rate environment, that sprint can lead you straight into a wall. This is where the slow BRRRR comes in. It's a strategic adaptation, a marathon, not a sprint. Instead of refinancing at the earliest possible moment, you deliberately hold the property on its initial financing for longer, maybe 18, 24, or even 36 months. Why would you do this? For two powerful reasons. First, you avoid refinancing into a punishingly high long-term interest rate. Second, you position yourself to refinance when rates are potentially more favorable. With the Fed signaling potential rate cuts in late 2025 and into 2026, patience can be incredibly profitable. So, how does it work in practice? During that extended holding period, several powerful things happen. You're paying down your initial, often higher interest loan. The property is appreciating naturally with the market. And critically, you're building an unimpeachable 24 or 36-month track record of consistent rental income. When you finally do go to a lender, you're not a speculative flipper. You're a proven operator with a golden goose asset. You'll get better terms, a smoother process, and a more favorable valuation. But the slow BRRRR has its own risks. The first is mismatched financing. You can't do a 24-month hold on a 12-month hard money loan unless you've negotiated clear extension options up front. The second risk is the rate gamble. You're making a calculated bet that rates will be lower in 2 years. What if they're not? You need a plan B, and the biggest philosophical risk is that it ties up your capital longer. It puts the brakes on capital velocity in exchange for safety and a potentially better long-term return. It's a trade-off you must be comfortable with. Whether you're sprinting with the classic BRRRR or running a marathon with the slow BRRRR, the refinance step is the engine that makes the whole machine work. It's the moment you convert the value you created into liquid capital that you can use again. Let's quickly recap the full process we learned from David Green's Playbook. Buy, rehab, rent, refinance, repeat. 1. You buy a distressed property below market value. 2. You rehab it, forcing appreciation. 3. You rent it to a great tenant, stabilizing the asset. 4. Then the refinance. This is the magic step. You get a new loan based on the new higher after repair value ARV. The goal is to do a cash out refinance to pull out all of your original investment and ideally more. 5. And finally, you repeat. You take the cash you just pulled out, your original capital, now free again, and use it to buy the next distressed property, starting the entire process all over again. The refinance is the mechanism that achieves true capital velocity. It's what gives you your capital back, allowing you to scale an entire portfolio with a relatively small amount of initial cash, recycling it from one deal to the next. The classic BRRRR was a sprint designed for a low-rate era to maximize speed. The slow BRRRR is the patient, strategic marathon for today's more complex market. The message from this series is clear. Refinancing is a powerful, multifaceted tool for the savvy real estate investor. By conducting a strategic audit, avoiding analytical traps, and using advanced adaptive strategies like the slow BRRRR, you can turn the equity in your properties into fuel for massive portfolio growth. Your challenge today: take one of your properties or a potential deal you're analyzing and run the numbers for a slow BRRRR. Project the value and loan balance today, and then project it again in 18 months, assuming modest appreciation and a slightly lower interest rate. Does the patient approach significantly change your potential return? Start thinking in longer time horizons. Thanks for tuning into this special series. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one smart move at a time.